Welcome, everyone. Matt Piepenburg and myself, we're back for another MAMChat. And Matt, certainly are exciting times. For most people, it's actually not exciting. It's pretty nervous. This now has gone around the world already. It started in the US, 3 banks failing or having to be saved in the course of a week. And shortly thereafter, we see Credit Suisse disappearing overnight, basically, or over the weekend. Not a surprise to us, Matt. I've been talking about this for years. I mean, I wrote an article 2017 about the banking system, and especially Swiss banking system. That don't keep your assets in a bank, whether it's a Swiss bank or another bank, because the banking system is not safe. We don't know if it's going to go under and when it's going to go under, but we certainly know it's not safe. It's leveraged to an extent that they could never settle all the claims that if people start withdrawing money. And that's exactly what we've seen in the last 10 days now. People just withdraw part of the deposits and the banks fail. I mean, that shows you how fragile the whole system is. Credit Suisse, we had the experience already of Swiss banks for years, and I wrote about the fact that you don't keep your assets in the Swiss bank, don't keep your gold there, because we saw examples time and time again of the banks not even having the gold and having to go out and buy it when they had told the clients that they actually have gold. So that was the first example, and then of course Credit Suisse has had one disaster after the other. They've lost billions, trillions, billions at least.
So far.
So far. Well, that's gone now. And they had they had the hedge fund Archegos. That was about 5-6 billion. They had mis-selling of mortgages in the US, had to pay the Justice Department 5-6 billion. And it was so obvious, Matt, that we never know when something's going to happen, when a bank is going to go under. But that insurance, i.e., protecting yourself, like in our case, we believe physical gold is the best protection. That you do in advance of the fire, of the disaster. You don't do it when it happens, because that's too late. And so we warned, but you're not so the shareholders actually got some money, but the convertible bond holders, the what's it called, AT1, additional tier 1 holders of 16 billion Swiss francs, they got nothing. And they were so shocked. People expect to invest in debt instruments, get a higher yield than normal, because that's a risky debt instrument, and then they're so shocked when they get nothing back and so annoyed. I mean, it's obvious that you put money into a bank and you're paid for the simple reason that you're taking a risk, and then everybody expects the money back. Now, and now of course the whole system, all the AT1, all these bonds are actually under pressure around the world now. And they rightly should be. And I know asset managers, for example, many Swiss asset managers who invested in this bond. I can't, for the life of me, Matt, understand how can they put investors' money, normal people's money, into a risky bond. I wouldn't put it into any bond today. And if you do, at least put it into a government bond. Governments normally don't fail overnight, neither the Swiss nor the US. What they do instead, they fail over time. They fail gradually, which means that they just print more money, and the money becomes worthless gradually. So now we have the Matt. We have the Swiss system. Everybody is worried about, well, Switzerland's safe, but as I have been warning in article after article, yes, the Swiss banking system is as vulnerable as any other banking system. It's too big for the country. It's 5 times Swiss GDP, so that makes it more vulnerable from the point of view that the Swiss National Bank has to print more money, and they've already printed a lot of money in their big hedge fund balance sheet. But this is not different to any other banking system. You're talking, and I know you'll talk more about that, Matt. But the American banking system is just a paper come out from some academics. That's U.S. banking system is 2 trillion down if you value the assets at market. But of course, this Silicon Valley Bank, for example, they were also investing in long-term bonds, but valuing them at maturity, which is absolute lunacy and criminal to do. They should be valued at market, even if the rules say that if you hold them to maturity. But of course, everyone will say that they hold them to maturity, even if they won't, because then they don't have to value them at market. So if you value assets at market in the U.S. banking assets, so there's a 2 trillion loss, and that's, Matt, I know you'll talk more about this. It's only interest rate related. We will have bad debts, Matt, in every sector of every bank here, and that will exacerbate those losses dramatically. There are 18 trillion deposits in the U.S. banking system. And I know I don't want to. I know you want to talk. You're going to talk more about it. But that they're now talking about, the Treasury are talking about insuring all the assets.
Yeah.
In U.S. banking system, because that's the extent of the problem. There's clearly a problem, just like we've seen in Switzerland. One bank had to be saved. The same problem exists all around the world. The EU banking system is an absolute mess. The ECB knows that, and they're all panicking, these central banks, and that's why they're talking about now insuring everything, because they can't insure everything. That's the end of the world. I mean, that's hyperinflation, many times over.
Yeah.
So people should not think about Switzerland as being the example of bad management from the bank point of view, because it's global. It's this global debt of 300 trillion plus, as I have stated many times, derivatives of probably another 2 quadrillion. And remember, when they start to actually go bad, and central banks have to save them too, and that's when we get debts, as I said, of many quadrillion, as I've said in many articles. So this is the extent of the problem. Don't think that it is local to one bank or one country. Investors shouldn't think that. They have to understand that this is a global problem, and therefore it's an incredibly fragile banking system. And people should, if they want to preserve some of their wealth, they should keep it outside of the banking system. And as you know, we believe that gold is the physical gold outside the banking system is the best insurance you can have. And because if you keep your money within the banking system, you will at least lose the value of your money just by the debasement of the currencies, because the printing is going to increase dramatically now. But also we will have the risks, as we've had now, of the banks failing. Matt, I mean, you have so much more to say about the US system, so let's go over to you.
Yeah, look, I mean, here we go again, another banking crisis, and just a different zip code. To your point, you're the Swiss citizen, I'm the American citizen. We're both based out of Zurich. We both have strong perspectives on banking risk. We've written about it for years. Credit Suisse, as you rightly said, is a banking issue, not a Switzerland issue. It's a global issue. What we're seeing in the US, again, is the more things change, the more they stay the same. We've got another liquidity crisis in American banking, just like we have in European banking. And again, Credit Suisse, you could just as easily say Deutsche Bank, which has been on the radar for years too, with massive amounts of risk and debt and non-performing loans and derivative exposure. But in the US, here we are, 2023, another banking crisis. It is different, but it's always the same. It's a liquidity crisis. 2008 was fascinating because we had billions and trillions of toxic subprime private debt packaged as AAA security when it was just, I hate to say it, horse droppings wrapped in tinfoil and sold as investment grade debt. It wasn't. It sent a lot of banks like Lehman and Bear to the bottom, and then a few other banks had to be bailed out by AIG and CDS and et cetera. So it was a disaster in private crappy debt. What's fascinating about 2023 and the current zip code, the current debt banking crisis today, is it's not about private subprime debt. It's about U.S. treasuries. Our U.S. treasuries, the most important treasury, the most important sovereign bond in the world, which is supposed to be risk-free return, but now it's return-free risk on nominal and real terms. We cannot underestimate the significance of a banking crisis led by a sovereign bond crisis in US Treasuries. It's disgusting. It really is. It's sickening.
Yeah.
And so, how did this happen? How did this happen? And as usual, in every crisis, you see a central banker hiding in the corner with his head down, looking for excuses. I'm quite convinced that Jerome Powell must have studied economics. Apparently, though, he didn't study history, because somehow Powell thinks that he can be Paul Volcker in the 1970s or 80s, when U.S. debt was less, U.S. public debt was less than $1 trillion. Well, now we have 31 trillion in public debt. We have over 95 trillion in public, corporate, and private household debt. So to raise rates like Volcker in 2023 is absolute suicide. It's absolute suicide. And we're not America in the 70s. We're more like America inflation in the 1940s, coming out of World War II, when we had so much debt that we couldn't raise rates this quick, this fast. But what Powell has done is raise rates from 0 to 500 basis points in a year. So it's too much, too fast. I mean, normally banks love higher interest rates. They can arbitrage by borrowing low and lending higher rates. But when you raise rates this fast, this high, you create a classic example of duration risk, massive duration.
Matt, yes, you're absolutely right. But the central bankers have clearly decided that this is the route they're taking. And as you know, my view is that interest rates are now, after 40 years down, they're now in a long upturn cycle, uptrend. So and you look at ECB, I mean, 50 basis points. So they knew what was happening, and they still did that. So America will continue, in my view, regardless of the risk, with this. Maybe not this time, but in the future. So that it won't stop because of this, I'm sure.
No, it's an interesting point again, because you do wonder, I mean, was this it's so stupid, is it intentional? Is it complicity or ignorance? Because there's going to be a massive consolidation to more centralized control. Bigger banks are going to consolidate, buy the good paper off the smaller banks and give the bad paper to the public. And you're going to see less and less smaller banks like Silvergate or Silicon Valley Bank or First Republic, or they're going to disappear, and you're going to see the rise of the bigger banks, and more importantly, the real rise of the central bank centralizing control. Because as you said, mark to market, American banks have 2 trillion in losses now, 2 trillion mark to market. And the days of extending and pretending in the smaller or larger banks, when a lot of the depositors or S&P companies, which were using debt today to pay for yesterday's loans, and then new debt tomorrow to pay for tomorrow's loans, they can't roll over that debt at a higher rate environment. So there's going to be a lot of non-performing loans and a lot of mark-to-market loss in their treasury book. So it's a perfect storm. The question then is, with 2 trillion in losses and 600 billion in unrealized losses on the regional banks, how did the banks not prepare for this? How did the smaller banks not prepare for this? And it's a moral hazard, terrible management. But the market and the banks always assume that the Fed's going to come in at the last minute and save them. So they're creating this incredible moral hazard. And it's all coming home to roost. 2023 is going to be a chaotic year. And US banks, they've got a massive perfect storm of solvency issues, liquidity issues, and profitability issues. Their liabilities don't match their assets. These smaller banks don't have a diverse book of good performing loans and valuable US treasuries, so that when there's a liquidity crisis, they can't meet the depositor needs. There's a massive depositor flight right now to money markets, because depositors can get more money on higher yielding discounted bonds in the money markets they can get at their checking or savings account at bank X, Y, or Z. So banks are going to need to enhance their depositor rates, which is going to kill their profitability. So smaller banks in particular have a profitability issue, a solvency issue, and liquidity issue. It's a disaster. And as we've warned, and I've written and you've written literally for the last 2 years, and certainly last year, that something was going to break, and that the bond market is the thing. We saw 3 prior fissures in the bond market in the last few years. We saw, and we've written about, the repo crisis in September 2019. That was a massive bond market red flag. Then we saw the 2020 March disaster, when sovereign bonds were falling as fast as stocks. Then we saw the gilt implosion last October in the UK. And this year, coming to 2023, right on cue, a banking crisis and a US Treasury crisis, because the bond market is the thing. We have toxic US sovereign bonds, not subprime mortgages this time. So, all of this is pretty obvious that we're heading towards consolidation to the bigger banks. The smaller banks in the US it's going to be the same thing in Europe. Hundreds and hundreds of banks are going down and have gone down and will go down over the years, because the bigger banks have more support from the Fed, the repo markets, the discount windows, the smaller banks are going to become less and less important. We're seeing, as you talked about mark to market, even the U.S. Federal Reserve mark to market is a $1 trillion loss. It's a bankrupt bank with a mouse click money. We're also clearly going to see the rise of more control. Central bank digital currency is on its way, and probably already this year in the U.S., the Fed Now program, which is the precursor to CBDC, is open to start in July. So we're heading in the name of payment efficiency, more control, more centralization. So Egon, all of the themes that you started with and that we've talked about for years, a debt crisis, a banking crisis, a currency crisis, a sovereign bond crisis. All of this, points back to, and again, not to beat a dead horse, it's just common sense, points back to gold. And, this is where we come back to the question of gold in particular and Swiss jurisdiction. Again, not to confuse Switzerland's jurisdictional safety with Credit Suisse's Swiss banking problems, because banking, as you said, is universal and global. But gold outside of this banking system has never been more important than right now. And that's not talking in our book, it's talking common sense. I'd like to get your thoughts on this because decades ago, you saw this. It's better early than late. It's hard to be right. People don't want to hear it. It's not an I told you so moment. But as you see all these things unfolding, Egon, everyone wants to hear about gold. We've talked about it, but it must be interesting from your perspective to really, really see, it's time for brass taxes now, though. The rubber's hitting the road.
Yes, certainly. The problem is, as you say, I've been standing on the soapbox for over 20 years, telling people that the risk is here, protect yourself. No one knows when things are going to happen. No one, but when they happen overnight, as we see now. And bond disasters will also happen overnight. Bonds can go quicker than anything else from 100 to 0, like that. And therefore, people have to protect the risk. And now even more so, as you just explained, that the risk will now be centralized in a few bigger banks because the smaller ones can't actually survive. But that means that the risk will be multiples in the bigger banks because they're taking over all the liabilities, like UBS now. They're riskier than before, much riskier than before. And the same with the, remember that the big banks have all the derivatives. You take the Goldmans and the JP Morgans, Bank of America, and Goldman Sachs, etc. They have the tens of trillions or more of derivatives. And that risk, just like the bond market risk, will materialize one day. So don't wait for it to happen. And this is what we've been saying for 20 years. Still, today, only 0.5% of world financial assets are into gold. But that's going to change. And, we've urged people to go in, buy physical gold now while it's still available and still cheap. And this is the way to ensure your wealth against a collapse of the system. That will happen, whether it will be gradually, like Hemingway said, or it'll be suddenly. It doesn't matter. You've got to be insured. Now, don't believe that, Switzerland is, okay, the banking system is just as bad as any banking system in the world. It's not worse. It's just as bad. But the Swiss economy is probably the best economy in the world. It's got the lowest deficit, lowest debt of any Western economy, basically. And it's got a very sound political system. So Switzerland is as sound as ever when it comes to actually holding money and politically also extremely safe. And it has an old tradition of, it's the biggest gold country in the world from the point of view of refining, 70% of all the gold in the world, having the biggest private gold vaults in the world. And that doesn't change. What changes is, or what, not in our view, because it's been the same, but what people should realize is the banking system everywhere. And the US banking system is as bad or worse because it's much bigger. And the debt and the derivatives are much bigger there too. So people should keep as much as they can, as we have been telling them for years, outside the banking system. I know it's not conventional investing, but this is not the time to be conventional, man. This is the time to actually take action against the trend and against the what people think is common sense. There's no sense at all to invest in stocks and bonds today because those markets are so risky. So we say to people, please think, we're not in any way trying to sell what we are doing. We say whatever, you buy the gold where you think it's the best place for you, but store it in a very safe jurisdiction. Every country will have problems also. The US will have major social problems, major, and the bail-ins are going to happen everywhere. There's going to be bailing, but the bank is going to start bailing in account holders now. They can't afford to support everything themselves, so that will come also. There weren't any bail-ins now, almost of the bond holders, but that's not deposited. So,
right.
So, but that will come. Bail-ins will come. That's what they said 2008, and it will come again. So just please be careful, everybody, and protect yourselves and your family, because what's going to happen in the next few years, and it can happen overnight or it can take another few years. Nobody knows, but get protection now. That's what we ask everybody. Well, Matt, we are certainly going to have a lot of things to talk about in coming months and years, because I think this is now, as I wrote in my last article, I think this is it. This is at the level now when it's going to happen at an accelerated pace, all of this. That's why central banks are now meeting all the time, and trying to calm the people down. But sadly, they have, except for printing more money, that's the only thing they can do, and that's just going to debase all the money that people have, and actually make the situation worse. Matt, a final word from you?
I couldn't agree more. As usual, Egon, we have pretty much similar worldviews and micro views, but to your point, and we've talked about this, and the world knows this. Raising rates into the greatest debt bubble in history was going to break something, and things are breaking. And 2023 is really breaking. It's off to a broken start in ways that, again, no one can time. This is not a time to be conventional. Being independent and free thinking doesn't have to mean being sensational. It just means common sense. To your point earlier, friends or people we know who bought poor loans thinking it was a safe bond market when the world is drowning in debt. You have to think differently now, not sensationally. You have to think commonsensically and be prepared and not be naive. There's safety in numbers, but I think the vast majority of people reaching for yield in bad bonds and a dangerous credit market is a disaster. And sometimes the solution is as elegant as a glass of water when you're thirsty or a baguette when you're hungry. And it's gold when currencies are dying. And this is what we've been talking about for years. And I think this year is already off to a record-breaking start with risk. So, all these messages have to be repeated, and there's a lot going to be to talk about this year.
Absolutely. And people must realize that this is not for amateurs anymore to decide what to do with their money, because the people like ourselves who are actually are enlightened about what's happening around the world and understand the risks in every country. For example, we analyze from the point of view where to keep gold, where to store it, which jurisdiction, etc. We analyze that constantly, and if we feel that people should move to another jurisdiction to be safe, we will recommend that and move it for them. So it's not a question of take your gold home and put it in the cellar and it's safe there, because that's the worst place you can keep it, with the crime rate increasing in the future. You should not store your gold at home, that's for certain. But you should have the flexibility of moving it whenever necessary, because things are going to, as I said, move very quickly now, and you've got to be very nimble.
Yes, absolutely.
Matt, thanks for this time. I think we will have a lot more exciting things, or frightening things to talk about in the next few months. So we'll leave it there. And thanks very much, Matt. And goodbye to everybody.
To you.
Thank you for listening. Thank you very much. Bye-bye.